In this video, I want to highlight how macroeconomic indicators influence market timing decisions. How macroeconomic indicators influence market timing decisions. When we talk about macroeconomic indicators, they kind of provide key insights into the overall health of the economy and help investors to accurately gauge market trends. These indicators are used to predict short-term market movements, though they do not guarantee outcomes. You could use them actually to predict market movements, to forecast, how the market will behave in future, but they do not actually give you a guarantee of what the outcome, would be in future. These are the key indicators we want to consider. Number one here is GDP. GDP simply means gross domestic product. So a growing economy, typically signals rising stock prices, while a shrinking economy may lead to market decline. In other words, when we talk about gross domestic product, we're making reference to the totality of the production of goods and services within an economy, within an economy in a specified period of time. So usually these two factors, will come together to actually highlight the health of the economy, the production of goods as well as services within an economy, within a given time frame. And so even there's that increase in production of goods and services, that indicates a growth in gross domestic products. And generally, whenever there's a growth, whenever there's an increase in domestic products, it always translates to an increase in stock prices in the markets. And if there's a shrinkage or reduction, in gross domestic product, it will affect the stock market negatively. Another factor that is worth mentioning here is inflation. Inflation. So high inflation can lead to higher interest rates, often negatively impacting stocks. So low inflation typically suggests economic stability. In an atmosphere of high inflation, that is, inflation simply means an abnormal increase in the price of goods and services in the economy. Whenever there's an abnormal increase or rising prices of goods and services, that phenomenon is known as inflation. And so in an inflationary environment, it tends to affect the stock market negatively because people's buying power is curtailed and people may not really invest in the market the way they ought to because of the limited buying power of the funds they have at their disposal. And not only that, they may not be able to patronize products and services, which will in turn affects a company turnover and revenue. And once revenue and turnover are affected, when it comes to productions in the company, you discover that it will affect the bottom line, the profit. And once profits are affected, then of course earning per shares will be affected negatively, and that will certainly trigger a drop in stock prices and of course the entire market. So you equally want to take into consideration unemployment rates. So higher unemployment signals economic distress, and it kind of weaken consumer spending, and so often leading to market downturns. When there's unemployment, an unemployed individual will not have enough money to really spend, As when you have a high rate of unemployment, that means that you have people in the economy that cannot uh, that have no way without to really buy goods and services as expected, and so that low patronage will certainly affect company sales and turnover, and that would not go well with stock prices. And so low unemployment indicates a strong economy. Whenever there's low unemployment, it indicates the fact that the economy is strong. And in a case where there's high unemployment, it's an indicates the fact that it indicates the fact that the economy is not doing well. When we consider interest rates, rising interest rate can reduce borrowing and investment, often hurting stock prices. Generally, whenever the central bank, increases interest rate, you discover that the cost of borrowing is going to be high. Okay, so with the higher cost of borrowing, people may not borrow as much as expected, or they could borrow less. And the lesser they borrow, the lesser their ability to invest or to consume. And so with a reduction in consumption and investment level, the stock market certainly will be influenced negatively. And so lower rate generally encourages the investments and can boost stock prices. Whenever there's a lower rate, people would tend to borrow at at a lower interest rates, and that would encourage investing in the stock market, as well as you know uh, as well as a larger level of consumption of goods and services that would impact the economy positively. And we want to equally consider consumer confidence. High confidence suggests strong spending and economic growth, while low confidence may indicate market pullback. When consumers are no longer, they lack the confidence to go out and spend money. People are just like, they are laid back. They don't want to commit, the little money they have into spending. They are very cautious and frugal when they come to spending. You would discover that it would affect the economy somehow, and it will equally lead to a pullback in the stock market. Stock market prices prices in the stock market would certainly plummet because of lower consumer confidence. I should not forget that lower consumer confidence equally translates into lower investor confidence, because most of the times investors are consumers and consumers are investors, so it tends to affect the market generally. Another, key indicator is retail sales. Retail sales. And so strong sales reflect a healthy economy. When people are buying at a higher level, when you have higher same store sales, you discover that it indicates that the economy is doing vibrantly. The economy is quite vibrant, and so which can drive stock price, and it will then drive the growth in stock price, while weak sales may signal a slowdown. When you discover that same store sales is going down, compared to the last year rate, it shows the economy has taken a downward turn, and usually the economy affects the stock market and vice versa. You discover that whenever people don't buy as expected, then definitely it's going to affect company turnover and profits, and that would equally translate into consumer confidence, and that would equally have a negative influence on stock prices. The last item here is the manufacturing data. Manufacturing data. Robust manufacturing often signals economic expansion, whereas weak data may suggest a contraction. Whenever there's a higher level of turnover of goods and services, it shows the economy is doing well. When companies, cut back on production or on the provision of services, that will indicate the fact that the economy, is getting weakened. So using these indicators, investors use macroeconomic data to forecast economic cycles. It could be either in a growth stage or in a recession. So they can predict central bank actions, interest rate changes. Usually, when the economy is down, the central bank would rush in to do something about it. That's a major role of the central bank, to actually uh, control and see how they could control these indicators one way or the other. And this would also we need to also look at market sentiments, that's consumer confidence, because all these factors they tend to affect market confidence or investor confidence. However, they tend to affect market sentiments, and uh, that's another aspect where consumer confidence comes in. However, relying solely on these indicators for market timing can be challenging due to delays in data release and the complexity of market reaction. The fact is that data that relates to these indicators they don't really come out. They don't come out on time. Unlike news feed, where you have up-to-date news coming in 24 hours, 247. This other one takes time. Before you compile retail sales, you compile manufacturing data, you compile, unemployment rate, GDP growth, or otherwise as the case may be, it's not as timely as one should expect. And so it's difficult to be able to compile these things on time and react, based on the outcome. So it takes time, and that could really delay market reaction to these factors. And if you are the proactive kind of investor, it will affect you. It will affect your decision making process somehow. So while macroeconomic indicators are useful for guiding market timing decisions, they should be combined with other factors for more comprehensive strategies. Other factors like company fundamentals. It's good, we consider those things so as to be able to have to make uh, to make a better decision as it relates to how we handle our investments.